ETF, index, and mutual funds. People use these interchangeably, and that's a mistake because they're not answering the same question. In fact, one talks about how a fund is traded. Another talks about how a portfolio is built. And there's yet a third distinction that almost nobody talks about. When you understand these three layers, you'll never be confused by fund labels again. And once we separate those layers, something interesting happens. The passive versus active debate suddenly makes more sense. Before we unpack all three layers, there's something you need to see first, and that's what these investments have in common. Because once you understand their shared foundations, spotting the difference between them becomes really easy. So many people skip this part, but this is the reason why so many arguments about funds go nowhere. ETFs, index funds, and mutual funds all share the same basic DNA. They pool money from different investors, they buy a basket of securities, stocks, bonds, or other assets. This means diversification is built in. Instead of owning just one company, you own dozens or hundreds or even thousands of different companies. They're all regulated investment products with disclosures, prospectuses, and reporting rules. They all charge expense ratios. They can distribute dividends and/or capital gains. And most importantly, their long-term performance is determined by what they own, not the label on them. So hearing ETF or mutual fund doesn't tell you if something is risky, conservative, expensive, cheap, good, or bad. You always have to look under the hood. Instead of thinking of ETF, index funds, and mutual funds as three competing products, think of them in terms of two independent dimensions. The first is how the fund trades, ETF versus mutual fund. Second, how a portfolio is managed. That's passive, usually index tracking, versus active. Every real-world fund sits somewhere on this graph. You can have an index ETF, an active ETF, an index mutual fund, or an actively managed mutual fund. Once you see that, the whole category becomes much simpler. Two funds can have the exact same investments, yet feel totally different to own. Let's start with the trading mechanics. ETFs trade on the stock exchange just like individual stocks. So throughout the day, the prices can go up and down. They trade through regular brokerage accounts, just like you're probably using now. Because they trade on the market, you'll see a bid-ask spread. And just to clarify what a bid-ask spread is when a seller comes and says, I want to sell my shares, but I'll only sell them at this price or above, they put in a limit order for that. When a buyer comes in and puts in a limit order, they say, I want to buy shares, but I only want to pay this much or less. The difference between those two is your bid-ask spread. ETFs can also trade slightly above and below their value of the underlying holdings. This would be the premium or discount to their net asset value, although market mechanics keep this pretty small, so you can argue it's pretty insignificant, but hey, it is there. Mutual funds trade differently. You don't trade them during the day. In fact, you put in your order, and at the end of the day, they calculate the net asset value and everybody trades on that price. So there are no intraday swings, no prices going up and down throughout the day. There's no bid-ask spreads or anything like that. Mutual funds are usually bought directly from the fund family or through a retirement account. Some have minimum investment amounts, some don't. Many allow automated investing so that you can dollar cost average, like every pay period you set a certain amount goes towards this fund. Same assets inside, different user experience. This is the debate everyone has, but most people frame it the wrong way. Now let's separate management styles, passive or index-based. Because there is no giant staff researching and picking stocks, making trades, the cost tends to be low. Active funds are different because portfolio managers have teams of people analyzing companies, stocks, trends, interest rates, etc. They decide when to buy, when to sell, how much risk to take, and when to make the changes. That introduces higher potential upside. However, it also introduces manager risk, style drift, higher turnover, and higher operating cost. It's also important to remember that both these styles can exist in both ETFs and mutual funds. If two funds own the same investments, why can one quietly leave you with much less over time? Fees compound just like returns do, but in the wrong direction. A small difference in expense ratio may not matter over a year, but given decades, it can chip away at a significant portion of your ending wealth. Trading costs inside a fund also matter, although you don't see them directly. Taxes matter too, especially in taxable brokerage accounts. Funds with high turnover rates may distribute capital gains. Even if you reinvest the funds, this may be a taxable event for you. ETFs often have structural advantages, which makes those distributions less frequent, which is why they're more popular in taxable brokerage accounts. These fees, trading costs, and taxes don't make headlines, but they do have an impact on your long-term results. If active management struggles on average, why do institutions pay for it? Some markets are harder to analyze than others, like small caps or emerging markets, or certain bond sectors may be less efficient, making room for a more skilled manager. Highly concentrated strategies may sometimes exploit specific insights, and long-tenured managers with disciplined practices matter more than a flashy performance. Actively managed investing isn't useless, it just requires more selectivity and patience. Pension funds don't argue ETFs and mutual funds the same way retail investors do. You see, large institutions like family offices and pensions build their portfolio in layers. They may add a passive core with ETFs to get broad exposure to the market at low cost. Then they may add an active strategy where they believe that the skill from the manager will overcome the fees. You see, large institutions look at more than just the fees. They have risk budgets they look at. They track errors. They look at the performance. If a given fund isn't performing, they'll just replace it. They will rebalance systematically as needed. They're not going to chase headlines. You see, in an institution like that, they're not about picking sides. They're about finding the right tool for the plan. Let's stop debating. Here's how to actually choose what fits your situation. First, ask yourself, is this in a taxable account or is this in a retirement account? Do I want to automate my investing, dollar cost averaging, or do I want intraday control? Do I want to be able to buy and sell at will? How fee sensitive are you? Fees range widely, and over a long period of time, they can matter. Will I stick with an underperforming fund? How long will I stick with it? For many long-term investors, part of their foundation may include low-cost index funds, whether they are ETFs or mutual funds. Active funds may play a role in certain niches or tax advantage accounts. There is no universal answer. Everything is personal. Nothing I say is financial advice. You should take this as information for your homework or take to your financial advisor and get more advice, because your specific situation will be very different than mine or anybody else's. Now that you see the structures, the whole thing becomes so much simpler. They all pool money, they all diversify, they can all buy the same assets. ETF versus mutual funds tell you how the fund trades. Passive versus active tells you how the fund is managed. Combine these two ideas and almost everything fits neatly into place. Structure, the holding, the cost, and how they're going to fit into your strategy. In future videos, we're going to go deeper into ETFs, mutual funds, strategy, structures, expense ratios, and all that good stuff. Thanks for making it to the end. Well, I hope you found value in this video. If so, please follow for more.